Hey, welcome back. Here is a question worth thinking about seriously. When you place a trade today, who or what is on the other side of it? Increasingly, the answer is not a human being sitting at a desk making a judgment call. The answer is an algorithm, a machine, an artificial intelligence system that processed millions of data points in milliseconds and decided to take the opposite position from yours before you even finished clicking the buy button. We are living through one of the most significant transformations in the history of financial markets. Artificial intelligence and quantitative trading systems are not the future of markets, they are the present. And their influence is growing faster than most retail traders realize. Understanding how these systems work, what they can and cannot do, and how this transformation affects your trading is not optional for anyone who wants to participate in modern financial markets intelligently. Today, I am going to break down the evolution of quantitative trading, how artificial intelligence is changing the game, what this means for retail traders specifically, and how to adapt your approach in a market increasingly dominated by machines. Let us get into it. How quant trading started and where it went. To understand where we are today, you need to understand where quantitative trading came from and how it evolved. Quantitative trading, which most people simply call quant trading, began in the 1970s and 80s when a small number of mathematicians and economists started applying statistical models to financial markets. The idea was simple but powerful. Instead of relying on human judgment and intuition, use mathematical rules and historical data to identify patterns that could be systematically exploited for profit. Early quant strategies were relatively straightforward. Statistical arbitrage, meaning finding price discrepancies between related assets and profiting from the gap closing. Momentum strategies, meaning buying assets that had been rising and selling assets that had been falling based on the statistical persistence of those trends. Mean reversion strategies, meaning betting that extreme price moves would revert toward historical averages over time. These early quant funds, including pioneers like Renaissance Technologies and D.E. Shaw, produced extraordinary returns in the early years, largely because they were competing against purely discretionary human traders who were not using any systematic statistical analysis at all. As the 1990s and 2000s progressed, more and more capital flowed into quantitative strategies. Technology improved dramatically. Computing power that once required entire rooms of hardware became available on desktop computers. Data sets became larger and more accessible. By the 2000s and early 2010s, high-frequency trading emerged as a dominant force. These are systems that hold positions for milliseconds or seconds rather than days or years, exploiting tiny price discrepancies at enormous speed and volume. High-frequency trading firms invested hundreds of millions of dollars in infrastructure to shave microseconds off their execution times, including building dedicated fiber optic cables between major exchanges. The practical result of this evolution is that by the time most retail traders are thinking about a simple trend following or technical analysis trade, quantitative systems have already identified the same pattern, traded it thousands of times across thousands of assets, and often extracted most of the easily available profit from it. How artificial intelligence changed everything. Traditional quantitative trading relied on rules that humans explicitly programmed. A quantitative analyst would identify a pattern, write a mathematical rule that captured it, backtest that rule against historical data, and deploy it. Artificial intelligence, specifically machine learning, is fundamentally different. Instead of humans writing explicit rules, machine learning systems identify patterns in data that humans may never have explicitly noticed or been able to articulate as rules. Here is the core difference in plain language. A traditional quant system might say, buy Bitcoin when the 14-day RSI crosses above 50 and the price is above the 200-day moving average. That rule was written by a human who observed this pattern and decided it was worth testing. A machine learning system ingests thousands of features simultaneously, including price data, volume, order book depth, on chain metrics, social sentiment scores, options market data, correlations with other assets, macro indicators, and hundreds of other inputs, and discovers its own internal rules for how these features relate to future price movements. Rules that are often far too complex and multidimensional for any human to articulate explicitly. The latest generation of artificial intelligence systems used in trading includes deep learning models that can process unstructured data like news articles, earnings call transcripts, social media posts, and even satellite imagery to extract signals that traditional quant models completely missed. Natural language processing allows trading systems to read and interpret financial news in milliseconds, making trading decisions based on the content of a news release before a human analyst has even finished reading the headline. Sentiment analysis systems track social media and news sentiment across thousands of data sources simultaneously, looking for early signals of shifting market opinion that precede price moves. Reinforcement learning, where artificial intelligence systems learn by trying strategies and receiving rewards or penalties based on outcomes, is producing trading systems that discover entirely novel strategies that no human explicitly designed, essentially learning through millions of simulated trading experiences how to extract profit from market dynamics. What this means for market structure today. The dominance of algorithmic and artificial intelligence driven trading has fundamentally changed how markets behave in ways that directly affect every retail trader. Change 1. Increased speed of price discovery. Information now gets incorporated into prices faster than ever before. When significant news breaks, natural language processing systems read, interpret, and trade on that news in milliseconds. By the time a retail trader reads the same headline and considers how to trade it, the market has often already fully priced in the information. Trading on breaking news is vastly more difficult for human traders than it was before algorithmic systems dominated. Change 2. Pattern exhaustion happens faster. When a genuine price pattern exists in market data, algorithmic systems identify and trade it far more quickly than human analysts. This accelerates the process by which profitable patterns get arbitraged away. Patterns that worked for years in earlier, less automated markets often stop working within months once algorithmic systems identify and systematically trade them. This has significant implications for technical analysis strategies built on historical patterns. Change 3. Liquidity conditions are more complex. Algorithmic market makers provide enormous liquidity during normal conditions, making it easy to enter and exit positions. But during sudden, unexpected events, these same systems can withdraw liquidity instantly, creating flash crashes where prices move dramatically in seconds with very little trading volume. Understanding that liquidity can disappear rapidly during stress events is essential for modern risk management. Change 4. Correlations between assets increase during volatility. Algorithmic systems often hold similar positions across many different assets based on similar signals. During volatility spikes, these systems de-risk simultaneously, causing many different assets to move together suddenly in ways that can surprise investors expecting lower correlation. What retail traders can learn from the quant evolution? You might be thinking that all of this sounds discouraging for retail traders. And in some ways, the competitive landscape has genuinely gotten harder for certain types of short term technical trading. But the quant evolution also offers lessons that retail traders can directly apply to improve their own approach, even without access to sophisticated technology. Lesson 1. Think systematically rather than intuitively. The core insight of quantitative trading is that systematic, rule based decision making consistently outperforms discretionary, intuitive decision making over large sample sizes. This is something every retail trader can adopt. Defining your trading rules clearly before entering any market, backtesting those rules honestly, and executing them consistently is a quant mindset that does not require any special technology. Lesson 2. Use data to challenge your intuitions. Quantitative thinking means testing assumptions against data rather than accepting them because they feel right. Many widely believed technical analysis patterns have very limited statistical support when properly tested. Approaching your trading strategies with the question, does the data actually support this, rather than, does this look right to me, is a fundamental shift in thinking that consistently improves decisions. Lesson 3. Focus on time horizons where machines have less advantage. Algorithmic systems have enormous advantages at short time horizons, from milliseconds to hours, where speed and processing power dominate. But at longer time horizons, covering weeks to months to years, the advantages of speed and processing power diminish significantly. Fundamental analysis, on-chain research, sector trend identification, and cycle analysis all operate on timescales where patient human judgment still adds genuine value. Lesson 4. Use the tools that democratize quant capabilities. Many tools that were once available only to institutional quant funds are now accessible to retail traders for free or at low cost. Backtesting platforms, on-chain analytics dashboards, quantitative screening tools, and even basic machine learning libraries allow retail traders to apply genuine quantitative thinking to their own strategies without requiring a mathematics PhD or institutional resources. The human edge in an AI-dominated market. The most important question for any retail trader in the age of artificial intelligence trading is this: where do humans still have a genuine edge that machines do not? The answer is more substantial than most people realize. Narrative and context understanding. Artificial intelligence systems are extraordinarily good at processing structured data, but still struggle with genuinely understanding narrative context, emerging cultural shifts, and the qualitative assessment of technological innovation. A human investor who deeply understands a specific technology sector can still identify emerging opportunities before quantitative systems that are primarily trained on historical price and market data recognize them. Long-term judgment under genuine uncertainty. Machines excel in environments with sufficient historical data to learn from. In genuinely novel situations where the future does not resemble any historical precedent in the training data, human judgment based on deep contextual understanding can still add significant value. Patience and emotional discipline. Ironically, the psychological challenges that make trading hard for most humans also represent a potential edge when properly managed. Systematic long-term strategies that require holding through significant volatility are actually underexploited by machines focused on shorter-term signal extraction. Patient human investors who can hold quality positions through temporary pain without being shaken out by short-term volatility occupy a space where automated systems are not competing as directly. Identifying structural market changes before they show up in data. Quantitative models are trained on historical data by definition. They can be slow to recognize fundamental structural shifts in how markets work until enough new data has accumulated. Humans who understand the mechanics and drivers of markets at a conceptual level can sometimes recognize these shifts earlier. Let me bring this together. Quantitative trading began with human designed mathematical rules applied systematically to financial data. Artificial intelligence transformed this by allowing machines to discover their own patterns across enormous complex datasets, including unstructured data like news and social sentiment that traditional models could not process. This evolution has changed market structure fundamentally. Price discovery is faster, patterns get arbitraged away more quickly, liquidity can disappear suddenly, and correlations spike during volatility as similar algorithmic systems de-risk simultaneously. For retail traders, this means certain short-term technical strategies face genuine headwinds in a market dominated by faster, smarter machines. But the lessons of quantitative thinking are directly applicable. Think systematically. Test assumptions against data. Focus on longer time horizons where machine advantages diminish. And use the democratized quant tools now available to everyone. The human edges that remain are real. Deep qualitative understanding of emerging narratives. Judgment under genuinely novel uncertainty. Patient long-term discipline that machines optimized for shorter horizons do not exploit as heavily. Markets have always evolved. The participants who thrive are not the ones who resist the change, but the ones who understand it deeply enough to find their place within it. If this video gave you a clearer picture of how AI and quant trading are reshaping the market environment you operate in, please hit the like button and subscribe. Drop a comment below and tell me this. Does knowing that machines dominate short-term trading change how you think about your own strategy and time horizon? I read every comment. I will see you in the next one.